Today, will the Fed put a put at 40%? Hello again, it's Martin North from Digital Finance Analytics. Welcome to this post covering finance and problem news with a distinctively Australian flavour. Albert Edwards at Societe General has once again highlighted the risks in the financial markets and that the coming bust will surely be devastating. He said at the end of 2021, he wrote about 4 surprises that will shake the markets. First, he said equity markets will surprise and fall sharply as US tech unravels in the first half. While valuations are currently squeezed by higher bond yields, the bigger surprise will be that tech earnings disappoint, shattering confidence in the validity of their high PE growth valuations. He said second, if an equity bear market unfolds, investors may find that while the Powell put still exists, the strike price may be a lot lower for equities than it was at the end of 2018. Would the Fed really hold back if the S&P was down 30% plus? And wouldn't that be one huge surprise for investors? Third, the easing supply bottlenecks combined with soggy commodity prices will drive US headlines CPI inflation well back below 2%. Hence, current inflation fears will evaporate as the first half unfolds and bond yields will decline sharply. Well, he didn't get it all right, of course. And fourth and finally, continued growth will disappoint in China, and the face of tight money will force Powell-like policy pivots, including a rapid devaluation of the renminbi. But now he writes, certainly these predictions seem to be playing out roughly as expected, with the exception of the third surprise, the rapid decline in bond yields as inflation subsides. But he says, I'm pretty convinced now that we've just seen the peak of US 10-year yields in this cycle at 3.20, just a tad below the 3.25% at the end of 2018 peak in the last cycle. From now on, however, he says the imminent reality of global recession will take a firmer grip on market sentiment and pricing. It's now consensus, he said, that the Fed will tolerate a deeper equity bear market because of the inflation situation. Still, he says, I think investors will still be shocked when a massive 30% decline in the S&P and all the associated carnage doesn't force the Fed to deviate from its current aggressive chest-beating stance. But he says as a decline of around 40%, which would be close to 3,000 on the S&P, the soothing burr of the QE printing presses will likely once again be heard. And that point might be much closer than people think. Indeed, an important update by quant guru Solomon Tradisi has increased confidence that Fed funds are close to the peak for this cycle. And he said, what a bizarre world it is now, where a Fed funds rate of only 1% blows up the markets. US financial conditions have tightened considerably in recent weeks, and severe cracks are beginning to be seen in the asset valuation Ponzi scheme that the Fed and others have inflated over this last and previous cycles. Like any other Ponzi scheme, it needs constant feeding with new money to keep the charade afloat. But having let the inflation genie out of the bottle, the Fed is now determined not to ease policy yet, despite financial conditions tightening. Hence, bond yields unusually are now rising in line with tightening financial conditions. But, he said, for how long? It then refers to this fantastic 3D chart showing that we're in the midst of a valuation-led bear market, with the most expensive stocks in the market falling the quickest. These recent events dovetail nicely with his strong view, often repeated, that the US tech sector would drive the next equity bear market into a deep slump, once compounded specifically by the huge weight of the FANGs and technology sector more generally in the index. Just the biggest 5 tech stocks comprise some 25% of the S&P 500 recently. Most commentators are rightly focused on the vulnerability of the US tech sector to rising bond yields by dint of that sector's growth-style credentials. But No one has been making the argument that the sector would implode because profits would begin to disappoint for these growth stocks in a slowdown, and more dangerously, in any recession. And by contrast, tech investors were delighted with the outperformance of the sector during the last recession, and this only cemented their belief in the sector as a nailed-on dead-cert growth theme deserving of ever superior multiples. Hence, the explosive multiple expansion of US tech, which really started at the time of the Powell pivot at the end of 2018 but ended at the start of this year, with the sector hitting a 30 times forward PE. That's a huge premium versus the market's PE of 22 times. He absolutely believes the turmoil that US tech and internet stocks, including the FANGs, are now experiencing is something similar to what was seen in 2000 and 2001 through the tech wreck. Back then, the Nasdaq and tech more generally collapsed as a long overdue recession flushed out cyclical stocks masquerading as growth stocks. The profit disappointments in US tech during the 2001 recession were such that the whole sector collapsed. The carnage back then was indiscriminate, and the genuine growth babies were thrown out with the scummy cyclical bathwater. So he says, I think GMO's Jeremy Grantham is right. Yahoo News reports that Grantham believes we're in the midst of a fifth great bubble of the modern era, following the Wall Street crash of 1929, the Japanese asset bubble of 1989, the dot-com blow-up in 2000, and the global financial crisis of 2008. But Grantham argues the US economy can likely weather dramatic drops in the stock market, as evidenced by the mild recession when tech stocks blew up during the dot-com bubble. But when it comes to a housing crisis, he says, the economy is unlikely to come through that unscathed. The dot-com bubble of 2000 showed you can just about skate through a stock market event, but Japan and 2008 showed you can't skate through a housing crisis. Maybe the day of reckoning for the US housing market has arrived, because record house price inflation at around 20% year over year has just been smacked by soaring interest rates. 30-year fixed-rate mortgages have risen from 3% at the start of the year to above 5.25% now. That's their highest level since 2009. But the residential property bubble is a truly global event, and the US isn't the worst offender. UBS calculates the bubbles are far worse elsewhere, with somewhat incredibly Frankfurt being the biggest bubble of all time, followed by the usual suspects. Having created an everything bubble, we know from 2008 what path we are now headed down. And yes, he says it will be different this time. It'll be worse. I'm Martin North from Digital Finance Analytics. Many thanks for watching, and I'll see you again next time.